This is the semiconductor index since April 1st, over 60% in 5 weeks, the fastest vertical move in the history of the SOX ETF. And this is the ES futures. The S&P 500 has added over $1.3 trillion in value since that same date. Oil was around 100, Iran was escalating, and consumer sentiment just hit a record low of 48. And yet everything went up. As a former hedge fund trader, I have invested in markets like this before, and what I'm seeing right now has a very specific pattern. But something happened on April 1st that almost nobody on financial television explained. And by the end of this video, I will show you exactly why that something is now close to running out of fuel. Keep the number $4 trillion in mind, it becomes critical in about 2 minutes. On November 25, 2025, the Federal Reserve, the OCC, and the FDIC quietly finalized a rule change. It went into effect on April 1, 2026. The rule is called the Enhanced Supplementary Leverage Ratio, the eSLR. Think of it this way: regulators used to force the biggest banks to keep a large safety cushion, money that could not touch, could not lend, and could not invest. It was locked away in case things went wrong. On April 1st, they shrink that cushion. Overnight, $200 billion that was sitting on the sidelines become available. $200 billion just for the banks. But here is where it gets bigger, and this is the part nobody is explaining. Banks do not just use that money directly, they lend it, they leverage it, they use it to back trades for hedge funds. And they use it to fund short-term borrowing markets and to buy government bonds that require zero additional capital. So that's 200 billion multiplies into a potential $4 trillion in additional buying power across the entire financial system. If you want to stay ahead of the institutions instead of buying their backs, and if you want to learn directly from me, a former hedge fund trader, subscribe now so you don't miss my next call. $4 trillion, that is not my number, that is from the US banking agency's own calculations published by ING. And the capital flowed into two places: prime brokerage, giving hedge funds and institutions more leverage to buy stocks, and repo markets, lowering short-term funding costs. In my view, the same mechanism that freed $4 trillion in potential asset capacity is now the system's biggest liability, because leverage always has an expiration date. That is also the reason for the explosive call options activity in semiconductors and in tech stocks. Look at the S&P 500 chart. The big measured move from the April low, the mechanical leverage-driven impulse, has already completed. The follow-through move is smaller and weaker, and I think this is a textbook exhaustion pattern. The fuel is being consumed, and there is another layer of leverage being added right now that nobody is talking about. The CSE just approved the removal of the pattern day trader rule, the PDT rule, effective June 4th. The 25,000 minimum equity requirement for day trading is gone, so the base margin requirement drops to $2,000. And this opens the door for millions of retail accounts to trade with leverage they have never had access before. So at the exact moment, institutional leverage is already at historical levels. Now look at oil. Crude oil inventories are depleting at a record pace. Saudi Aramco CEOs just warned that global fuel stocks are heading for, and I quote, critically low levels. The strategic petroleum reserve stood at 392 million barrels as of May 1st, and the administration is exchanging another 53 million barrels. Projected level in 120 days if no deal is made is 243 million barrels. This is critical, and this is a very low number that I was warning that the oil right now is in a very tight place. And tanker vessel crossing through the Strait of Hormuz remains near zero. Well, of course, there are vessels that are going undetected, and this is not part of the official data, but keep in mind that these vessels are very low in numbers. This is not just about your portfolio. Oil above $100 feeds directly into fertilizer, shipping, and food prices. Farmers are entering planting season with input costs 30% above last year. This is going to hit groceries bills by Q3. And here is the proof, released this morning. The consumer price index for April just came in at 3.8% year over year. That is the highest annual pace since May 2023. Energy alone is up 17.9% over the past 12 months, gasoline 28% higher than a year ago, and food is up 3.2%. Wall Street spent the last 2 months telling you that oil prices would normalize. They have not, and oil is still above $100, and the CPI data just confirmed that. So in my opinion, this is no longer a short-term shock, it is becoming very structural. That was what I was warning about in my previous videos. And that brings me to the Fed's problem. We are getting to the part that actually surprised me. The Fed follows the 2-year yield in its rate decisions. The 2-year is currently trading above the Fed funds target of 3.5 to 3.75%. Core PCE, the Fed's preferred inflation goal, is running at 3.2% year over year, 60 basis points above target. And the components the Fed has the least control over, shelter, energy, food, are all accelerating. The CPI just confirmed that. And yet the Fed Watch tool which shows low probability of a rate hike price into any remaining 2026 meetings. The market is betting the Fed stays patient, but I ask myself, how can you not hike rates when oil is still above $100 per barrel? Let me give the bulls the strongest version of their case. Buybacks are still open, dealer gamma is positive and supportive, a Trump Xi summit is approaching and could use China as a back channel to resolve Iran. So if oil falls below $80, the PCE pressure thesis breaks. I understand that argument and it is not unreasonable, but here is what the data shows. The top 10 stocks now control 36 to 40% of the entire S&P 500. At the peak of the dot-com bubble, that number was 41%. That is the highest market concentration in a century of data. Semiconductors alone are up 60% since April 1st, and the way I see it, that is not because earnings exploded very high, but it is because leverage exploded. And now let me show the elephant in the room that nobody wants to talk about. Private credit. The market barely existed before 2008, and today it sits at $3.5 trillion in assets. This is Goldman Sachs data. And look at where that money went. Nearly a quarter of all US direct lending, the largest slice, is in technology, the same sector that just rallied 60% on leverage. And what is the problem? Most of this debt is floating rate. So when rates stay high or go higher, every single borrower's interest payment goes up. And many of these companies are not publicly traded. So you cannot see the stress until it is too late. In my last video, I told you to watch the CPI and PPI. I said if this print comes in hot, the Fed is trapped. Today's CPI just came in 3.8%, the highest in 3 years. I'm not going to say I told you so, but the data just did. Now, there are 2 dates that matter. May 28, this is the core PCE, so if it comes in above 3.5%, the Fed cannot justify patience. And the eSLR generated leverage, the same fuel that freed $4 trillion in asset capacity, becomes the accelerant of the unwind. And then June 17th. the Fed meets, and this is not a regular meeting. This is the one where they release the summary of economic projections, the dot plot. The market will know if the Fed is preparing to hike, hold, or cut. And with oil still above 100 and CPI at 3.8, I think the dots are going to shift hawkish. Loose financial conditions plus a tightening Fed equals forced deleveraging. And now millions of new retail margin accounts from the PDT removal will be in the blast radius. So watch May 28th, then watch June 17th. See you in the next one.